Welcome back to the deep dive. Look, usually when we sit down to record these, we have a stack of books, maybe a few academic papers, something a bit, well, dusty, something theoretical.
Right, something with some distance to it.
Exactly. But today feels different. Today feels like we are broadcasting from a bunker.
It definitely has that vibe. The dust hasn't even settled yet on this one.
It hasn't. Not at all. If you are listening to this, you know exactly what kind of weak hell, what kind of 48 hours we have just lived through. We are recording this in the immediate shell shock aftermath of early February 2026. And I don't want to mince words here. The markets are ugly.
They're a bloodbath.
There is fear out there. Real, visceral fear.
Volatility is the word the news anchors use when they don't want to scare the public.
Right, the sanitized corporate term.
Yeah. But if you're a retail investor, if you've been holding silver, volatility doesn't quite capture the feeling of watching your portfolio value just evaporate in a straight vertical line.
No, doesn't even come close. I've been on the forums. I've been reading the emails coming in. People are panicked, utterly panicked.
And you can't blame them.
Of course not. We saw silver, this asset that was supposed to be the safe haven, the one thing we could count on, take a nosedive that just defied logic.
It was stunning in its speed.
We had the crash on February 2nd, which was bad enough. And then just when everyone thought, okay, that's the bottom, we can breathe now, we got hit again.
With a sledgehammer on February 6th.
The infamous double bottom.
That's the one.
And the sentiment right now, it's just exhausted. People are tired.
They're beyond tired. They're demoralized. The questions are pouring in.
They are. Is the bull run over? Did we get played? Is this 2011 all over again where we just bleed out for the next 5 years?
That 2011 comparison, that's the one that carries the most trauma for people.
Absolutely. And that is exactly why we scrapped our original plan for today's deep dive. Because a document crossed our desk this morning that, well, it changes the entire conversation.
It's an intelligence briefing. And that's not just marketing fluff. The title itself is provocative.
What's it called again?
The Lightning Repricing. And the document we are analyzing today isn't written for the average retail guy checking his Robinhood account on his lunch break.
No.
It's written for the red team.
And that's the hook. That's what stopped me in my tracks. It explicitly states right on the first page that this analysis adopts the persona of a red team market strategist.
Which is a very specific mindset.
It is. Before we even look at the numbers, and we have some absolutely insane numbers to get to, including a price target that frankly sound delusional until you see the math. Can we just unpack this concept?
You have to. It's the key to the whole thing.
What does it mean to be a red team strategist in the context of a financial market that looks like it's crashing and burning?
It's a concept borrowed directly from the military and intelligence communities. It's fascinating.
If you're the general, right, you have a plan. You have a strategy. You have a narrative of how the battle is going to go.
The blue team plan. The official story. Exactly. But you have a massive blind spot. You want your plan to work. You're predisposed to see things that confirm your strategy.
Confirmation bias.
It's confirmation bias on a massive scale.
Yeah.
You see what you want to see. So what do you do to counter that? You bring in a red team.
And their job is to tear your plan to shreds.
Their job isn't to agree with you. Their job is to be the enemy. Their job is to look at the battlefield from the perspective of the adversary, or in this case,
The perspective of the smart money.
the banks, the institutions, the algorithms, the big predators. The red team doesn't look at the narrative. They look at the plumbing. They look for these structural weaknesses that the general public, the blue team, if you will, completely ignores.
So applying that here, the dominant narrative right now, the blue team view is panic, sell, the chart is broken, silver is dead.
Correct. That's what the price action tells you. That's what the financial news is screaming at you.
But the red team's job is to ask a different set of questions.
A completely different set. They ask, what if that panic is a feature, not a bug? What if this crash wasn't an accident at all?
What if it was a sophisticated controlled demolition?
Designed to clear the path for something much, much bigger. That's the core thesis.
Controlled demolition. I have to say, that phrase gave me chills when I read it because it implies intent. It implies that what we just went through wasn't chaos. It was engineering.
It implies precision. Think about it. A controlled demolition brings a building down into its own footprint. It's not a messy, random explosion.
So you can build something bigger on the same spot.
You got it. So you can build a skyscraper on top of it. If you don't clear the old structure, the weak hands, the leverage, the stop losses, you can't build the next phase of the bull market.
The foundation isn't stable.
The foundation is cluttered with baggage. The thesis of this briefing is that the crash was the necessary prelude to a historic rise. You had to have the demolition before the construction could begin.
Okay, so our mission today as the Red Team is to take you, the listener, from that state of confusion, that feeling of watching the price and feeling like a victim, to a state of, well, strategic advantage.
To move from being the hunted to being the hunter.
Exactly. The briefing says we need to stop watching the speedometer and start watching the engine. We're going to break this down into three main pillars.
Lay them out.
First, the anatomy of the crash. What actually happened on Feb 2nd and Feb 6th and why those dates matter. Second, that speedometer versus engine analogy, which I think is going to save a lot of people's sanity.
It's a game changer of a concept.
And third, the mathematics of $500 silver. Yes, you heard that right, $500.
And we are going to talk about the miners too, because if the metal is the engine, the miners are the rocket fuel.
Right. The sucking sound on the upside. We will absolutely get to that. But let's start at the scene of the crime. Section 1, the anatomy of the crash.
Let's do it.
Take us back to February 2nd. What did the Red Team see that the rest of us, staring at our screens in horror, completely missed?
To understand this, you have to understand the timeline. It's not just one event. It's a 1-2 punch designed for maximum psychological impact.
Okay.
So on February 2nd, 2026, silver takes a massive hit. It drops to $71. Now, in isolation, a drop to 71 isn't the end of the world. It's a correction. It shakes out some of the latecomers, the tourists.
Sure. Markets go up, markets go down. $71 is still a very high number historically. You're not wiped out.
Exactly. You're nervous, but you're holding on. But then came the waiting game. For 4 days, the market just chopped around. It didn't bounce back hard. It just churned.
Which builds anxiety. The hope for a quick V-shaped recovery starts to fade.
The anxiety builds and builds. And then February 6th happens, and the floor gives way completely.
And this wasn't a drift downward.
No, this was a trapdoor opening. We see a violent high-volume drop all the way down to $64.
And $64 is a specific psychological trigger. It's not a random number they picked out of a hat.
Not at all. You have to put yourself in the shoes of a trader or just an average investor. You bought at 75. You watched it go to 71. You held on hoping for a bounce.
You're telling yourself, don't panic. This is normal.
Right. Then it cracked 70. Then it cracked 68. By the time it hit 64, you aren't thinking rationally anymore. You're in fight or flight mode.
You're in what the briefing calls structural despair.
That's the phrase. It's not just regular fear. It's a feeling that the entire structure of the market has broken underneath you. All hope is lost.
I saw the headlines that day. Silver bull market broken, the bubble pops, technical damage irreparable. Felt like the end.
And that is the retail view. That is the intended emotional response. The retail view looks at a vertical red line on a chart and sees a loss of wealth. They see a trend that has failed.
With the Red Team.
The Red Team looks at that same chart and sees something completely different. They see an operation. They see a stop-loss harvest.
Okay, hold on. Stop-loss harvest. This is a term we hear thrown around a lot, sometimes in conspiracy threads, but let's treat it seriously.
Yeah.
From a structural standpoint, how does this actually work? Because it sounds like we're saying the banks can just decide what the price is.
It's not about deciding the price arbitrarily. It's about seeking liquidity. It's more subtle than that.
Okay.
Think of the market not as a smooth curve, but as a terrain map. Liquidity, the actual orders to buy or sell, isn't spread out evenly. It clumps together in predictable places.
Like pockets of oil underground. You just need to know where to drill.
That is a perfect analogy. Now imagine you are a retail trader. You buy silver. You are nervous, as you should be. You want to protect yourself. So what do?
You place a stop-loss order.
Exactly. You tell your broker, if the price drops below, say, $65, sell my position automatically so I don't lose everything.
Right. It's a safety net. It's standard risk management. Every textbook tells you to do this.
It's a safety net for you. But for an institutional algorithm, it's a target. It's a big, juicy steak sitting on the table.
How do they know it's there?
The smart money has access to data, to order flow information that shows them the aggregate order book. They can't see your specific name, but they can see that there is a massive cluster of sell orders sitting right under the $65 level.
So they know exactly where the trapdoor is.
They know exactly where it is, and they know that if the price is hovering at, say, 68, and they can use a little bit of capital, a few large sell orders in the paper market to push it down, just enough to touch $64.99.
Snap.
Snap. The trapdoor opens, and all those thousands of retail stop-loss orders trigger at once.
It's a chain reaction.
A cascade. Sell, 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 sell.
The market is suddenly flooded with silver for sale from people who aren't even consciously choosing to sell in that moment.
Their machines are selling for them based on a decision they made days ago.
Precisely. The price creates a vacuum. It plummets. And here is the red team question. Who is on the other side of that trade?
Who is buying when everyone else is panic selling? The same entities that pushed the price down. The banks. The smart money. They triggered the avalanche so they could stand at the bottom with buckets and catch the snow.
So they're not just causing the panic.
They're profiting from it. They are buying your silver at $64 silver that you probably bought at $75. They aren't panicking. They are accumulating. They are loading the boat.
That is, it's ruthless.
Yeah.
It makes the market sound less like a mechanism for price discovery and more like a hunting ground.
If you're watching the price, you're the victim. If you're watching the momentum, you're the predator. That's the core thesis of this entire briefing.
And it all comes back to that.
Every single point. This double-bottom event wasn't a sign of weakness in the market. It was a clean slate operation.
Okay, explain the clean slate theory. What needed to be cleaned?
The briefing argues that you cannot have a massive parabolic run to $500, which we will get to, I promise, if the market is cluttered with weak hands.
People who will sell at the first sign of trouble.
Exactly. If you have millions of nervous retail investors holding on with tight stops, the market is too heavy. It can't fly. Every time it tries to go up $5, someone takes profits. It creates resistance.
It's like trying to drive a car with the parking brake on.
A perfect way to put it. So you have to shake them out first. You have to purge them. You have to make the chart look so ugly, so technically broken, that the only people left holding silver are who the briefing calls the verified class.
The true believers.
The true believers. The people who understand the fundamentals so well that they would never, ever sell at $64. In fact, they're probably buying more.
They see it as a sale.
They see it as the gift that it's intended to be for them. Once you've wiped out all the stops under 65, the road ahead is clear. There is no one left to sell. There's no overhead resistance.
So the controlled demolition was about destroying the resolve of the retail investor so the institutional investor could take their position at a discount.
Precisely. It was a transfer of wealth, plain and simple. A maneuver designed to create despair, because despair creates liquidity. You cannot buy $1 billion worth of physical silver without spiking the price to the moon, unless you can convince everyone else to sell it to you first in the paper market.
Okay, that makes a terrifying amount of strategic sense. But I have to play devil's advocate here for a second.
Please do.
That's a great story. It makes us feel better about holding the bag. It's a compelling narrative. But how do we know it's true? How do we know the market isn't actually broken? Maybe the fundamentals have changed. Maybe the big money is selling for a real reason, and we're just telling ourselves a story.
That is the perfect question, and it's the perfect segue to Section 2, because you can't answer that question by looking at the price. The price is a liar. It's a puppet.
You have to look at the structure.
You have to look at the engine.
This brings us to Michael Oliver. The briefing leans very heavily on his work. For listeners who don't know him, who is Michael Oliver, and why is his work so important here?
Michael Oliver is a legend in the world of technical analysis, but he's not your typical lines on a chart guy. He's not looking at head and shoulders patterns or death crosses.
It's a different discipline entirely.
Completely. He developed something called momentum structural analysis, or MSA. And his core philosophy is something that is incredibly counterintuitive to most investors.
Which is?
That price is a lagging indicator.
That's so hard to wrap your head around. Price is the only thing we look at. It's the score on the scoreboard.
It's the score, but it doesn't tell you how the game is being played. It doesn't tell you who has the ball and where they're going. Oliver argues that momentum, the underlying energy and force of the market, changes direction before the price does.
So momentum leads, price follows.
Always. Price is easy to manipulate in the short term. We just talked about it. You can paint the tape, you can run stop losses, but you cannot fake the momentum structure on a quarterly or annual time frame. It's too big, too powerful.
It's like trying to change the direction of an aircraft carrier by pushing on the bow.
You can't do it. The underlying momentum is just too strong. And that brings us to the analogy the briefing uses, which I think is the most helpful visualization I've ever heard for this market.
The car on the mountain.
The car on the mountain. Let's really paint this picture. Close your eyes for a second. Imagine you are driving a high-performance car. a Ferrari, a Porsche, whatever you like.
Okay.
And you are driving up a steep, muddy mountain road. It's raining. The terrain is rough. It's a real struggle.
I'm in the driver's seat. I can feel it.
You are flooring it. Your foot is all the way down on the accelerator, but you hit a patch of deep mud. Or maybe the incline gets incredibly steep for 100 yards. What happens to your speedometer?
The wheels start spinning. I lose traction. The speedometer drops. I'm going 80, then 60, then 40. It looks like I'm slowing down.
Right. Now imagine your passenger is a typical retail investor. He is only looking at the speedometer. What is he screaming at you?
He's screaming, "We're stopping. The car is dying. We're going to roll backwards down the mountain."
Yeah.
He's panicking.
Exactly. He thinks the car is broken because the price is dropping. But you are the driver. You aren't looking at the speedometer. You're feeling the car. You are looking at the tachometer. You are looking at the RPMs. What is the engine doing?
If I have my foot on the floor, the engine is screaming. It's at 7,000 RPMs. It's redlining with power.
The engine is generating massive power. The energy is there. The momentum is there. The car isn't dying. It is fighting through resistance. It's building up torque. That is the difference between price and momentum.
I love this. It's so clear. So applying it directly to February 6th.
On February 6th, the price of silver dropped to $64. The speedometer went down, and the retail passenger in the car panicked and jumped out.
He sold.
He sold. But Michael Oliver, the driver, looked at his momentum charts, the annual and quarterly momentum, and he saw that the engine was still screaming at 7,000 RPMs.
The structure didn't break, not even a little.
It didn't even crack. The briefing calls the crash a violent jiggle. On the price chart, it looks like a heart attack. On the momentum chart, it was just a little blip, a midpoint gut kick that didn't break a single long-term trend line.
So the underlying power of the bull market is completely intact.
Not just intact, it's building. The argument is that while the price chart looks like a disaster, the engine is actually building up pressure for the next phase.
And here's the physics of it.
Yes, this is the crucial part.
When a car with an engine at 7,000 RPMs, spinning its wheels in the mud, finally catches traction on some dry pavement, what happens next?
Yeah, it doesn't just accelerate slowly. It doesn't gracefully pull away.
No, it launches. It burns rubber. It snaps your head back.
It's a slingshot, a violent, explosive move forward. And that is what the red team expects to happen next. The mud patch was the $64 crash. We are about to hit the pavement.
Now, the briefing makes a really interesting comparison here to 2011, because a lot of our listeners, myself included, have PTSD from 2011.
A lot of scar tissue there.
A lot. Silver hit $50 and then it collapsed. For years. How do we know this isn't that? Wasn't the engine screaming then too?
This is a crucial distinction, and Oliver's work shows it clearly. In 2011, when silver hit $50, the car was moving fast, the speedometer was high, but the engine was exhausted.
What does that mean, the engine was exhausted?
If you looked at the momentum charts back then, they were rolling over, they were showing negative divergences. The engine was redlining in the bad, way overheating, losing power. The momentum broke before the price peaked. It was a warning sign that everyone ignored because they were just looking at the price.
So the engine failed first, and the car just coasted on its remaining speed for a little bit, and then stopped and rolled backwards.
A perfect summary. But in 2026, it's the complete opposite. The price is struggling in the mud, but the engine is fresh, powerful, and just getting warmed up.
And there's something else.
Yes. The briefing mentions a nitro boost that we didn't have in 2011, a new variable that changes the entire equation.
The industrial deficit. The physical shortage.
The physical shortage. In 2011, it was mostly a monetary and investment story. There was plenty of silver to go around. Today, the warehouses are being drained.
By who? What's using it?
Everything. Solar panels, electric vehicles, 5G networks, AI data centers. They are devouring physical silver faster than we can mine it. We are in a structural deficit for years to come. So you have a screaming engine plus a fuel injection of unprecedented physical scarcity.
So the red team conclusion.
The conclusion is that the car isn't dying. It is preparing for a gear shift into a gear that doesn't even exist on most cars.
And when that gear shift happens, that leads us to the numbers. And honestly, this is the part where I need you to walk me through it slowly.
Yeah.
Because Section 3, the mathematics of the repricing, well, it talks about a target of $500.
$500.
Now it's up. I have to be the skeptic. Silver has been trapped between $4 and $50 for 40 years, since the 1980s. To say it's going to 500, that's a 10x move from the all-time highs.
It is.
That sounds like hype. That sounds like YouTube clickbait. How can a serious intelligence briefing using red team analysis, justify that number.
It sounds like clickbait because you are thinking linearly. You and most of the market are suffering from what the briefing calls the arithmetic trap.
Okay, explain the trap. What is the linear arithmetic way of looking at it?
Most traders, especially those trained in the last 20 years, look at a chart like a ruler. They see a defined range. They say, okay, the trading range for the last 40 years was about $45 wide. The low was around 5, the high was 50. So we have a $45 box.
Right, that's the established territory.
So, the reason. Now that we have broken out of the box, we're trading above 50, the target is simply the height of the box added to the breakout point.
So $50 plus $45
Yeah.
equals a target of $95.
$95, and that seems logical. $95 silver would be incredible. I'd be very happy with $95.
We'd all be thrilled.
And that is exactly where the traders sold. When silver started moving recently, the linear thinkers, the arithmetic crowd, they sold at 90 or 95 because their ruler told them the move was over.
They thought they were being smart, taking profits off the table.
They thought they were geniuses. But the briefing says they were early. Tragically early.
Because they missed the logarithmic truth.
Precisely. This is the key insight. When you have a generational breakout, not just a weekly trade, but a 40-year breakout from a massive base of consolidation, you don't add the points.
You multiply the ratio.
You multiply the ratio. You have to think in percentages, not in dollars. It's a different kind of math.
Give me the historical precedent. Show me where this has happened before.
Look at the last major cycle for silver itself. It moved from roughly $5 to $50 in the late 70s and early 80s.
Okay.
Now, a linear thinker would say that's a $45 move, but a logarithmic thinker sees something else entirely.
They see a tenfold move.
They see a 10x. It went up 1,000%. The ratio is what matters.
Okay, I follow. A 10x multiplier.
So, if we are starting a new secular bull market from the breakout point of that old high, $50, and we apply that same historical tenfold ratio, do the math. What is 10 times 50?
500.
$500. That is the logarithmic target. It's not magic, it's math. It's how assets reprice when they are released from long-term suppression. It happens in tech stocks, it happens in crypto, and historically it happens in commodities that have been undervalued for decades.
But hold on. A chart pattern is one thing. That's technical analysis. But does $500 silver make any sense in the real world? Wouldn't that destroy the economy? I mean, $500 is just... it's a lot of money.
Is it? Or has our money just become worthless? This is the second part of the equation, and arguably the most important, the M2 money supply adjustment.
We have to talk about inflation, the rebirth of fair value.
Right. We tend to think of a dollar as a static thing. A dollar in 1980 is a dollar in 2026. But we know that's not true.
$1 in 1980 could buy you a nice dinner and a movie. $1 today can't buy you a candy bar.
Exactly. It's not that the candy bar got more valuable, it's that the dollar got weaker. Since 1980, the U.S. government and governments around the world have printed absolute oceans of currency.
It's not even a linear increase. The charts of the money supply have gone vertical.
The M2 money supply, that's cash, checking accounts, savings, money market funds, has exploded. So you have to ask, what is silver really priced in? Is it priced in dollars, or is the dollar being priced in silver?
So there are way more dollars chasing the same, or even less, available silver.
Precisely. And the briefing does the math for us. It calculates that if you adjust for the expansion of the money supply to match the purchasing power that silver had at its 1980 peak of $50, silver would need to be priced at $450 today.
Wait, run that by me again? I need to process that. You're saying that $50 in 1980 had the same economic power, the same claim on real goods and services as $450 does today?
Yes. Just to maintain its 1980 peak value in real terms, it should be at $450. So the logarithmic target of 500 isn't some crazy overshoot. It's basically just catching up to where it should have been all along.
That completely reframes everything. We look at $64 and think, wow, it crashed. But in reality, $64 is pennies. It's a joke.
It's a theft. The market has treated silver as a dead asset for so long that we have forgotten what it's actually worth. The move to 500 isn't a bubble, it's a correction to fair value. It is silver finally accounting for 40 years of currency debasement in one violent move.
And the briefing calls this phase the lightning form. Why lightning?
Because of the speed. This is the scary part for anyone trying to time the market to get in and out. The briefing argues that because the suppression lasted 40 years, like holding a beach ball underwater for decades, when you finally let go,
It doesn't drift up slowly.
it rockets to the surface. It explodes out of the water.
It corrects in a single summer.
That's the quote. The idea is that the market is going to reprice silver from dead asset to strategic reserve asset almost overnight. There won't be time to think.
And that brings us back to the crash. Why crash it to 64 before going to 500?
To make the target look mathematically and psychologically impossible.
Right. If you are staring at 64 and your portfolio is bleeding and the news is telling you it's over, you cannot psychologically imagine $500.
Your brain rejects it. It feels like a fantasy. It feels like a cultish belief. And that is the goal of the manipulation, to keep you from seeing the destination so you get off the bus before it even leaves the station.
That is psychological warfare at the highest level.
Welcome to the red team.
Okay, so we've covered the metal, we've covered the crash, we've covered the $500 target. But there's one more piece of this puzzle, the highest octane part of the trade.
Where the real leverage is?
The miners. The companies that actually dig this stuff out of the ground. The XAU index.
The XAU. This is where the leverage lives. And this is where the red team sees the single biggest anomaly, the biggest mispricing in the entire financial system right now.
The briefing uses a phrase here that I can't get it out of my head. It says the XAU index is about to explode with a sucking sound on the upside.
A sucking sound on the upside. It's visceral, isn't it? It's not a gentle rise.
It sounds like a vacuum. Like a jet engine intake. A sudden, violent rush.
That's exactly what it is. It implies a vacuum of liquidity. It means there are no sellers left. When the price moves, it doesn't tick up. It gaps up. It gets sucked up violently because there is simply no stock available to buy at these levels.
But why are the miners set up for this? Why now? What's the fundamental reason?
It's the disconnect. We have to look at operating leverage. This is Finance 101, but in the heat of a panic, people completely forget it.
Break it down for us. Keep it simple.
Okay. Imagine you are a mining company. Your cost to pull an ounce of silver out of the ground is relatively fixed. You have to pay for the diesel, the labor, the equipment. Let's just use a round number and say your all-in sustaining cost, or AISC, is $20 an ounce.
Okay. Fixed cost, $20.
Now, a few years ago, silver was trading at $25, so you were selling that ounce for $25. Your profit margin was $5.
Not great. Thin margins.
Yeah.
The market hated you. Your stock price was in the gutter for a decade.
Exactly. But now let's look at the recent crash price of $64. Even at that low, panic-stricken price.
You're still selling that same ounce, which cost you $20 to mine for $64.
Right. So your profit is now $44.
It went from $5 to $44.
Your revenue might have roughly tripled, but your profit went up nearly 900%. That is operating leverage in action. The profits explode exponentially.
That is massive. The cash flow must be incredible.
But here's the kicker. The stock prices of these mining companies haven't moved yet. They haven't caught up. On February 6th, when silver was at 64, the mining stocks were priced as if silver was back at 30.
So the stock market is asleep at the wheel or looking backwards.
Completely. The market hasn't priced in the Niagara Falls of cash flow that these companies are experiencing. They are printing money. They're becoming debt-free cash machines. But investors are so scared of the double-bottom crash in the metal that they are dumping the stocks.
That is the definition of a market inefficiency. A profound one.
It's the opportunity of a lifetime, according to this briefing. Michael Oliver's prediction is that this disconnect cannot last. It's physics. You can't have a company making record profits trading at bankruptcy valuations forever.
Something has to give.
Something has to snap back to reality. He forecasts a breakout for the miners within 30 days. He says we are seeing a third assault on the structural momentum of the miners, and the third time is usually the charm.
And when that breakout happens, that's the sucking sound.
That's the explosion. The sellers disappear. The algorithms wake up and their models scream, oh my God, these companies are undervalued by 500%, and they chase it. Everyone tries to get through the same tiny door at the same time.
And what about the smaller companies? The junior miners?
Well, that's where the real lottery tickets are. For the junior miners, the smaller, riskier exploration companies, the briefing suggests we could see returns of 15x to 25x.
15 to 25 times your money. That is aggressive.
It is. But remember, they are playing catch-up from a much lower base. They have been beaten down for a decade. If silver goes to $500, a junior miner sitting on a massive proven deposit in the ground, the math just gets astronomical. You are revaluing their core asset by 1,000% while their costs stay the same.
It really feels like we were standing on the edge of a cliff. But depending on who you ask, we're either about to fall off or we're about to learn how to fly.
And that brings us to the conclusion of the briefing, the 2026 filter.
The 2026 filter. What is it?
The briefing says the events of February 2nd and 6th were a stress test. A filter designed to separate the market participants into two distinct groups.
And who are they?
The victims and the predators.
Stark. No gray area there.
It is stark. The victims are the ones watching the speedometer. They are the blue team. They are the ones who panicked on February 6th. They saw the price drop, they felt the fear, and they sold their positions.
They got filtered out of the market.
They got filtered out. They protected their cash, which feels safe in the moment, but they lost their position. They will be watching from the sidelines when the rocket takes off.
And the predators?
The predators are the ones watching the engine. They are the red team. They understand momentum. They looked at that same crash, that same $64 price tag, and they didn't see a crisis. They saw a gift.
An opportunity.
They saw a clean slate where the banks wiped out the weak hands so the real move could begin. They bought when you sold. They accumulated your shares.
There was also a brief mention of the dollar in the outro of the briefing, just to put a bow on the macro context here.
Yeah, it's the wind at our backs. It's the final catalyst. The briefing notes that the dollar index has broken its major trend line going back to 2010.
A decade-plus trend line.
The huge one. The paper value of the world's reserve currency is evaporating. That is why the engine is revving so hard in the first place. The dollar is losing its structural integrity just as silver is gaining its... It's the perfect storm.
So for the listener right now,
Yeah.
maybe they are sitting in their car, maybe they are at the gym, they are looking at their portfolio on their phone, they see red, they feel that knot in their stomach. What is the final word? What does the red team say to them?
The red team says, stop. Put the phone down. Stop looking at the ticker. The ticker is a weaponized instrument designed to manipulate your emotions. The verdict from the briefing is that you have a choice, a very clear choice.
What's the choice?
You can view the double bottom as a warning to get out and join the victims on the sideline, or you can view it as an accumulation gift, a final boarding call, and join the verified class.
And the briefing leaves us with one final provocative quote. I think we need to say it again, because it really sums up everything we've talked about today.
It's the mantra for this market. It's the filter itself. If you're watching the price, you're the victim. If you're watching the momentum, you're the predator.
If you're watching the price, you're the victim. If you're watching the momentum, you're the predator.
It changes how you look at every single red candle on the chart. When you see a drop now, you don't ask, why is it falling? You ask, who is shaking the tree and what are they trying to knock loose? It changes the entire game.
Powerful stuff. Look, this has been a heavy one, a really heavy one. We went deep into the mechanics of manipulation, the math of inflation, and the raw psychology of fear. But I hope it gave you a different lens.
A red team lens.
A red team lens to view the chaos. That's the goal. Clarity amidst the panic.
That's all you can ask for.
This has been a deep dive into the Smart Money Wisdom's intelligence briefing titled The Lightning Repricing. Thank you for trusting us with your time during what I know is a stressful period. Don't look at the speedometer, listen to the engine, and we'll catch you on the next one.
Stay sharp out there.